Dollar Tree is the first idea from Christine.
Yes. So a major operator in the discount dollar segment. They have two banners, Dollar Tree and Family Dollar. And just a general comment about the sector as a whole. We like this sector, especially going into an economic slowdown, because as you know, Andy, when consumers feel stressed in terms of, how much they have to spend, they actually go to these dollar stores and they actually gain traffic. And we've seen this with all the, Dollarama in Canada and Dollar General in the U.S. and Dollar Tree. Now, why Dollar Tree? Well, as I said before, there's new management in place, ex-executives of Dollar General who executed their turnaround. So Dollar Tree, typically in the past, they were like a fixed price point. Every item in their stores was $1. About a year ago, they started to implement a $1.25 price point. And then more recently, they're rolling out $3 and $5 price points. So that actually will help to increase basket size. They're seeing that. And they're also seeing higher income households, like 80,000 plus, come to their stores. And so they're, that will, provide more higher basket size and hopefully as well as stronger traffic. Now, Family Dollar was a banner they bought a few years back, and it was actually just not very well run. And the former managers just couldn't seem to get the assortment right. So with this new team in now, they've invested in pricing to really be competitive with their competitors. They've increased the SKUs, the number of items they sell in the stores. They're trying to increase store productivity, add more shelving, add more coolers in for frozen foods, which is good. And they cater to a lower income family. So they are seeing improvement in same-store sales growth in that banner. And so we think that with a lot of retailers this past year, they have had a headwind of higher transportation costs and freight costs. That is starting to trend down. So I think that's going to be a tailwind for the company next year. And because this company is not really performing up to standard to their competitors in terms of margins and traffic, we think that, this will be, once they show consistency in doing this, the valuation discount that they trade at will narrow, because right now they're trading at a discount to Dollar General as well as Dollarama.
Okay. What about Dollarama, just very quickly? Is that a company you like?
Very good operator, but the valuation, they're like 30 times forward earnings versus Dollar Tree at like 20 times. So it's fully reflected in its valuation.
Royal Bank of Canada.
Yeah, so that is one of the banks that we've owned for a number of years, and this is one that we put in money right now with its pullback. Royal, I think all the Canadian banks have shown their diversified business mix in terms of, yes, capital markets was weak this year, but, wealth management's held in. They're seeing loan growth. Royal Bank is also benefiting from the rise in interest rates. They're seeing the expansion in their net interest margin. We like their exposure to the U.S., where it's more sensitive to rising interest rates. The acquisition they did a few years back of City National has turned out quite well. And as in terms of valuation, along with most of the other banks, they are trading at a discount to historical average in terms of price to earnings ratio as well as price to book value. I think they're well positioned coming into this slowdown because, all the banks built up reserves, provisions during the pandemic, and they never really released all of them coming out of it. So, now they're starting to build up again. The capital ratios are very strong. Royal has actually one of the strongest capital ratios. They recently announced the acquisition of HSBC Canada, which will be under regulatory review. They hope to close it later next year. But once again, if it succeeds, that will be a nice addition to their wealth management side of the business and lots of cross-selling opportunities. And the yield of the stock is just over 4%. And we think they can continue to increase their dividend at a mid-single-digit range over the foreseeable future. It's
been a decent stock over 5 years. Bloomberg calculates a total return of about 53%, whereas the bank's index is a return of 38%.
Yes.
I guess partly hurt by Scotia over that period. Yeah. S&P Global. So they compile the indices, do they?
Yeah, they do have like 5 businesses, but they are a leader. Indices is one of their businesses, which is benefiting from the move to passive investing. All those ETFs, they have their name behind them, and they design new products with different themes. That's an ongoing product innovation area. As well, they are leader in the ratings industry, and that has suffered this past year, which is part of the reason why the stock has fallen back, because ratings, new issuance really just collapsed this year in terms of high yield and even investment grade. A lot of companies went to market last year and took advantage of very low interest rates to shore up their balance sheets. And this year, they found through the summer, high yield just dried up. I guess investors didn't want to, there was uncertainty and there was no market for high yield. So the issuance market has really dropped quite a bit, but that's not going to go on forever. As M&A returns, as debt maturities come off, they have to be refinanced. So I think that will eventually, so that's priced into the stock, the weakness in the issuance market. That's going to improve. And then as well, Market Intelligence is one of their divisions. They provide those terminals, Capital IQ, that investment professionals use. So all their business provide really need to have information to investment professionals, whether it's in the commodities market, they provide Platts, like benchmark pricing. So very scalable, very high margins. The operating margins on this business is very lucrative. They just closed on an acquisition, IHS Markit, that had fixed income information that they provide to the fixed income market. They're going to realize some synergies there. They had their investor day about a couple of weeks ago, put up some very attractive long-term growth targets. They think they can grow their top line organically, kind of in the 7 to 9% range, and also realize synergies from the acquisition. So, with this pullback, we think it's very attractively priced for long-term growth.
Christine, thank you very much.
You're welcome, Andy.
Let's take a break and have a look at the markets before we hand it over to Bloomberg Markets. And we have seen some heavy selling today. Wall Street Journal says polling data indicates that a majority of U.S. voters think the economy will be in worse shape in 2023 than it is now. Another joker in the pack here is apparently $4 trillion worth of options are set to expire tonight, and that can produce zigzag trading. So the TSX down 1%, and you can see the S&P now down almost 2%. As of today, the S&P 500 posting a loss of just over 19% so far this year. So even just in calendar 2022, we're almost looking at a so-called bear market. The Nasdaq now down 32% this calendar year. Thanks very much for watching. Keith Richards is up on Monday.